Hey, how's it going everybody? Thanks for tuning in. Be sure to subscribe to our YouTube channel to stay updated on all of our videos. So many people have reached out to me over the past few months asking about ETFs. So today I wanted to talk briefly about what they are and why I find them pretty cool. So for those who may be unfamiliar with the acronym ETF, it stands for an exchange traded fund. For simplicity's sake, I will refer to exchange traded funds as ETFs throughout this video. In order to set the stage, let's first visit the concept of buying a stock. If I want to buy 2 shares of Apple stock, I would have to use a brokerage service like Robinhood or TD Ameritrade to purchase shares of Apple. So imagine after doing my due diligence, I decide that I will buy 2 shares of Apple stock. Apple has been trading at around $130 per share, so in total, not including brokerage fees, I spent about $260 for the 2 shares of Apple stock. Now let's say I decide that in addition to buying Apple stock, I want to get some exposure in Microsoft. So now I will go back to my online brokerage account to purchase 2 shares of Microsoft for, let's say, $244 per share. In total, it will cost me $488 for those 2 shares of Microsoft stock. So now that I own Apple and Microsoft, I have $260 worth of Apple and $488 from Microsoft, which is equal to $748 total. As you may see from this example, it is pretty costly to buy individual shares of stocks. If I wanted to go buy Tesla and maybe a few shares of Amazon stock, that would cost even more money. However, this is where ETFs come into play. Certain financial companies like Vanguard and Fidelity offer ETFs to investors. ETFs are funds that own a large pool of stocks that an investor can purchase without having to pick individual stocks. These ETFs trade on the stock market like Apple or Amazon. I could invest in a Vanguard ETF that literally holds Apple, Microsoft, Tesla, and Amazon. Instead of having to buy individual shares of stocks, I can allocate that same $748 investment into an ETF that gives me more exposure to a broad range of large tech companies, and this also reduces my risk exposure as an investor. Vanguard has funds that cost roughly $300 per share, which is way cheaper than buying Apple and Microsoft stock individually. By purchasing shares in the ETF, I am paying lower costs for more diversification within my investment portfolio. To take this ETF example one step further, most people can remember when the Golden State Warriors dominated the NBA. It seemed like every year the Warriors were in the championship. Steph Curry, Klay Thompson, Kevin Durant, and Draymond Green were the main superstars on the team. However, the supporting cast like Sean Livingston and Andre Iguodala were great players that could step up to the plate if Curry or Klay had a bad game. The performance of the Warriors was balanced out because the team was stacked with reputable players at all times. In addition, Steve Kerr, who's the coach of the team, was able to manage the players in a way that limited injuries during the season because the team was balanced and diversified. This is literally the core premise of an ETF. These pooled investment vehicles are managed by firms like Vanguard with hopes of limiting the risk exposure for investors by investing money into a broad range of established companies. So if Apple has a bad day in the market, Amazon can step up and crush sales numbers. Or if Microsoft has a bad day, guess what? Tesla could step up to the plate that day because Elon Musk is a genius. So overall, ETFs are very interesting investment vehicles that allow individuals to purchase companies they know and love without having to pay as much money for specific stocks. In closing, I hope this analysis of ETFs helped broaden your knowledge, and be sure to stay tuned for more content at www.simpme.com. Thanks.